Welcome to Introduction to Farm and Ranch Taxes.
Hi, I'm Poppy Davis. I teach a class in agricultural taxation at the University of Arkansas School of Law LL.M program in agricultural and food law. I'm the primary author of these materials in close collaboration with my friend and colleague Winona Doris. Winona is a business skills consultant and trainer who works with farmers, ranchers, and fishers. She leads training on accounting, taxation, insurance, and cash flow at both the state and national level. Winona comes to agriculture through familial ties from her great uncle, Ed Scott, who was a successful claimant in the Pigford case against the USDA. Winona holds a BA in economics and accounting, a master's in business administration, a graduate master's certificate in taxation, and is licensed as an insurance agent and a tax preparer.
And it's my pleasure to introduce my friend and colleague, Poppy Davis. Poppy is a consultant and business skills advisor to agricultural and food and beverage enterprises and to nonprofits and local governments. She has worked as a CPA and at the United States Department of Agriculture and in various nonprofits. She holds a Juris Doctorate from Drake University Law School, a master's in journalism from Georgetown, and a BS in agricultural economics from the University of California at Davis.
The LL.M program in agricultural and food law at the University of Arkansas School of Law has been a leader in agricultural and food law for more than 40 years. It has nationally recognized faculty, specially designed courses, on-campus and distance options, and for more information, you are encouraged to go to the website.
This presentation is intended to provide general information on agricultural income tax issues and should not be construed as providing legal advice. It should not be cited or relied upon as legal authority. State laws vary and no attempt is made to discuss state-specific laws. For advice on how these issues might apply to your individual situation, consult an attorney. This project and materials created by Poppy Davis as part of the LL.M program of agricultural and food law at the University of Arkansas School of Law is part of the Agricultural Finance, Tax, and Asset Protection Program.
The Ag Financial Tax and Asset Protection Program has resources to enhance farmers, ranchers, educators, and others' ability to understand and navigate business tax and asset protection decisions.
There are a total of 5 lessons in this series.
For each lesson, there's a short questionnaire to help you decide if the lesson is right for you. Each lesson also includes a PowerPoint, a recording of the PowerPoint, and a PDF file with detailed supplemental information, including the presenter's script, additional topics for discussion and engagement, and additional resources. Hi, everybody. Welcome to Lesson 2, Records Training.
There are a total of 5 lessons in this series. This is Lesson 2 of the series.
There are 6 sections to this presentation. We start out with basic requirements and then move to special rules for businesses, and within that, special rules for certain kinds of business transactions. We will wind up with a discussion of how long to keep records and financial record keeping methods and practices.
In the event of an IRS inquiry or audit, you're required to present evidence to substantiate any claims the IRS questions. In the absence of evidence, the IRS may force you to take the least favorable tax position, and in some cases, you may incur negligence penalties.
Which of these do you think are evidence for the IRS? receipts, notations in a calendar, bank statements, credit card statements, sales brochures, conference agendas? The answer is all of these things.
Most of this presentation will focus on the requirements for evidence related to business income and expense, but there are other kinds of records you need to keep as well.
I'd like to make a special note now for enrolled tribal members operating on trust lands. If you determine that you are not required to file, and that's from lesson 1, you may still need records to prove that you qualify for the exemption. These records would include proof of your tribal enrollment and evidence that the land where you operate was either allotted under an act of Congress that specifically mentions tax exemptions, that's Dawes and several other related acts, or that the land is governed by treaty language, which has been interpreted as exempting income derived from the land from taxation. Also see the publication from Utah State Rural Tax Education, When is Tribal Farm and Ranch Income Exempt from Federal Taxes?
If you have income that was not officially reported to you, you are still required to report that income to the IRS. Because the amounts were already reported to the IRS will automatically generate a notice if they do not receive an individual income tax return reporting the same items. You should keep these records for 3 years after you file your returns. The IRS should already have these records, but the IRS has been known to lose records.
The tax forms you receive in the mail or electronically are simultaneously transmitted to the IRS. Any amounts reported directly to you on a W-2 or a 1099 are also reported to the IRS, so the IRS knows to expect your return, and they will contact you if you do not file a return and they have evidence from your W-2s or 1099s that you meet the filing requirements.
Itemized deductions are available to all taxpayers. They are not the same as business deductions, which are only available to taxpayers who run a business with a legitimate intent to profit. Many taxpayers take the standard deduction instead of claiming itemized deductions. All you have to do is claim the standard deduction, is look up the amount based on your filing status. To claim itemized deductions, you need to keep records and complete additional IRS forms. Itemized deductions include amounts paid for mortgage interest, property taxes, charitable contributions. Keep records to substantiate or prove your itemized deductions for 3 years after you file your return.
Generally, a taxpayer does not have higher itemized deduction than standard deduction unless they pay a mortgage on a primary residence or pay a large amount of state and local taxes. If you live on the same property where you farm a ranch, it may be somewhat complicated to calculate the amount of mortgage interest and property taxes to deduct on Schedule A for itemized deductions versus the amount on Schedule F for farm and ranch expenses. We will cover how to do this in lesson 6, but if this is your situation, you will definitely benefit from consulting a qualified CPA or enrolled agent.
IRS Form 1040 Schedule 1 lists a number of additional items of income, including income or loss from self-employment, rental income or loss, and income or loss from participation in a partnership or an S corporation. Schedule 1 includes a line for the total or net amount of calculated income from Schedule F.
So when you see income or loss, the income is net income or income after the related expenses have been deducted. Gross income is income without regard to any related expenses or deductions.
The IRS is generally concerned with underreported income. However, you may be asked to prove you have not overreported income. The tax return is used to qualify for many government programs as well as other private uses, such as qualifying for credit. There are many circumstances where a taxpayer benefits from overstating income, so the IRS may examine records to determine if income has been overstated. And overstating income is a form of tax fraud, even if it does not result in an underpayment of tax.
Checking or savings account statements and credit card statements can validate that an expense was paid. But unless the amounts are paid to a vendor that has a clear relationship to your business, you will also need additional records to show how the expense relates to your business.
Your supporting documents should identify the payee, the amount paid, proof of payment, the date incurred, and include a description of the item purchased or service received that shows the amount was for a business expense.
A combination of supporting documents may be needed to substantiate all the elements of an expense.
You go to a farm supply store and buy bulk seed and fertilizer. The receipt does not need an additional notation. The bank or credit card statement is also needed to show that you actually paid the amount on the receipt.
You go to an all-purpose store, Target or Walmart, and buy cleaning items and office supplies. The receipt needs a notation to explain that the cleaning supplies are for the farm office. You may need an additional notation to remove a personal item, say a children's toy that you bought, that you also purchased but did not deduct. You will also need the bank statement or credit card statement that shows the amount of the receipt was paid by you.
If you keep physical receipts, you can make the notation directly on the receipt. Note that most receipts now fade within a few months, so you should make and keep electronic copies as well. In a minute, we'll talk about bookkeeping systems and how they facilitate keeping the records the IRS requires.
Ordinary expenses are defined as customary or usual and common or frequent in the taxpayer's business and businesses like the taxpayers. Necessary expenses are defined as being appropriate and helpful for development of the business. An amount is reasonable if it is the amount that would be paid in a transaction between two unrelated parties.
We will discuss various types of evidence in a minute. Usually, it is not hard to have evidence of the amount of a transaction and proof that a transaction occurred. It can be more difficult to show that the transaction was an ordinary and necessary business expense, especially if your farm or ranch operation is closely related to your daily life. It can be hard to show which expenses are related to the business and which are personal. Remember, there are situations where taxpayers benefit for showing more income rather than less. So there are situations when underreporting deductions may be a form of negligence or fraud.
Assets have lasting value to the business. They include equipment, machinery, fences, wells, buildings, hoop houses, breeding animals, work animals such as roping horses or guard dogs, and trees or vines that bear annual crops. What is an ascertainable useful life? It means you know the asset will not last forever, and it can be objectively determined if the asset is still useful or functional. Buildings, trees, vines, fences, equipment, all of these things are depreciable assets because we can clearly see that at some point they will cease to exist.
Assets are depreciated over their useful lives or their tax lives, and in many cases, you may take bonus depreciation, and deduct the full amount in the year of purchase. As a matter of common practice, if an item will be used for more than 1 year but costs less than $500, the item is treated as an expense and not as an asset.
Land is an asset, but not a depreciable asset, because while the land might be alive, you cannot ascertain how long it may continue. It might go on forever, or at least far past our ability to imagine. Because we cannot determine that land has a life that ends, land cannot be depreciated. Some land improvements also have no ascertainable useful life and cannot be depreciated. We will discuss some special rules for special kinds of land improvements and farm assets in Lesson 6.
You can see publication 225 for more information on special rules for land improvements and farm assets. For more information about how to depreciate assets, see IRS publication 946.
Dairy cows, animals kept primarily for fiber, and roping horses are clear examples of animals that are treated as depreciable assets. For operations that are growing a breeding herd and also growing annual sales, it can be difficult to keep track of which animals are assets and which are held for market because you might change your mind. Livestock accounting is a specialized area. Fortunately, there are many great resources available through various extension programs around the country.
For more information on livestock accounting, see publication 225 and look for guidance from extension agents specializing in livestock operations like yours.
In addition to your asset list, you need supporting documentation showing evidence of when and how you acquired the asset, the purchase price, the cost of any improvements, depreciation deductions taken for casualty losses such as losses resulting from fires or storms, how you used the assets in your business, and the sales price of the asset if it is sold, and the terms of the sale, particularly if sold on contract or in partial exchange for another asset.
Examples of supporting documents include purchase and sales invoices, real estate closing statements, canceled checks, and other documents that identify payee, amount, and proof of payment, prior year tax returns with depreciation schedules as well.
When you sell an asset, the income is not part of your business income. It is reported separately as capital gains income. Capital gains are taxed at a lower rate than self-employment income. The capital gains income is the gross sales price less your basis in the asset, less the cost of the sale. What is basis? Basis is either cost basis, which is your purchase price or purchase cost or the cost to build, or it is gift basis, which is the donor's basis when they gave it to you. Or for inherited assets, you have something special called stepped up basis. Stepped up basis is the fair market value of the asset at the date of death of the person from whom you inherited. You may increase your basis in an asset if you incur costs by making improvements to it. Your basis in an asset decreases by the amount of the depreciation that would be allowed on your tax return. And it decreases by this amount even if you don't take that deduction on your tax return.
You need records to show your basis in any asset you sell. If you cannot provide the amount you claim as basis, the IRS will assume the basis is zero and you will owe tax on the full sales price of the item. Records to show basis include purchase records, tax returns showing depreciation, gift letters, and the tax returns of the person who made you the gift if you want to show that you have more than zero basis in the gift because they had more than zero basis in the gift. Estate tax returns or probate documents for inherited assets, receipts for any improvements you made. Records to show sales price include a sales receipt or contract or bank records.
So for vehicle-related deductions, under either the actual or the mileage method, you need a written record of the miles you drove, showing date, miles driven, where you went, and most importantly, why it was a business-related trip. You can switch from mileage to actual, but you cannot switch from actual to mileage. You may deduct tolls and parking separately in addition to vehicle expenses.
You can have a situation where you use both methods, but for different vehicles. You use the actual method for a vehicle that is owned by the farm or ranch and used primarily in that operation, but perhaps sometimes for personal use. You use the mileage method for a vehicle that is owned by you personally and sometimes used for the business.
The actual method farm or ranch vehicle is treated as a farm or ranch asset and depreciated along with all the other farm and ranch equipment, and all fuel and maintenance expenses are reported with other equipment, fuel, and maintenance expenses as farm and ranch expenses.
If the vehicle is occasionally used for non-business purposes, the owner is supposed to keep a record of the non-business mileage and calculate the percent of business to non-business use and reduce their total business deduction by the value of the personal use.
For a personal vehicle that is sometimes used for business, for example, driving to town to visit with your CPA and buy office supplies, people typically use the mileage method. The owner must keep a record of the business miles driven and may take a deduction for those miles using the mileage method.
You may deduct travel expenses relating to purchasing equipment, supplies, livestock, accessing veterinary, legal, accounting, and educational services, or developing marketing relationships and delivering your product to market.
Travel expenses include vehicle expenses, as discussed before, rental vehicle expense and related fuel or ferry, airfare, taxi or ride services, hotel, and meals and incidentals.
For meals to be deductible, you must be on a trip away from your regular tax home for 8 hours or longer. Your tax home is the general area in which you regularly conduct business activities, the radius around your farm you typically travel on a typical work day.
Many farmers or ranchers live fairly far from services and often travel several hours to the nearest town or city. That nearest town or city may be part of the area you consider your tax home if you regularly travel there and back within a regular work day. The next farthest town or city may be outside of your tax home. In order to be able to take a deduction for your own meals and incidentals for a travel day, you have to be outside of your tax home for a full 8 hours or longer.
For many farmers, the day they travel to a farmer's market is a 12 to 14-hour day, and they are outside of their tax home for most of the day. They can take a meals and incidentals deduction for those farmers markets days. Draw a circle around your farm as far out north, south, southeast, and west as you go in a typical day. That is your tax home. Everything else is away. For your own meals and incidental while traveling away from home, you have a choice similar to the one for vehicle expense, actual or per diem rates from the GSA table. To use the actual method, you must have your actual receipt along with a notation explaining the business purpose of the trip.
To use the per diem method, You do not need to keep any receipts, but you do need to maintain written records explaining the business purpose of the trip. You calculate the amount of the deduction using the per diem rates table published at least annually by the General Services Administration, or GSA, of the federal government. Look up the city that is your destination. If the city is not listed, use the amount listed for the county.
Business meal deductions are limited to 50%. If you look on the IRS form, you will see the line you enter 100% and then you subtract 50% to arrive at your actual deduction.
Note that the GSA tables include hotel expense. A self-employed person may not use the GSA tables for hotel expense. You have to have actual hotel receipts. Use the meals and incidentals part of the table only. Incidentals is for things like buying aspirin or sunscreen you may have forgotten to take with you, but later realize you need.
An example of appropriate documentation would be including in your employee policy manual the requirement that employees eat meals with the farm or ranch crew so they can be close by for emergencies or because town is too far away. Or in some cases, as part of them understanding how the food grown or raised in the farm is prepared and served and how it tastes.
Note that when you prepare the meals you serve, the 50% deduction limitation does not apply to the salaries of the people who prepare the meals or to the cost of the facility where the meals are prepared. So for some small farm operations, the only part of the deduction that would be limited is the cost of supplemental ingredients purchased.
Examples of when the meal is for your convenience is if it is provided at your place of business. It enables the employee to work overtime. You are far away from a place where your employees could reasonably leave, go buy a meal, and return within the time allotted for a lunch or dinner break. You provide the meals to enable the employees to be close by for emergencies.
Examples of when the meal is not for your convenience. You provide meals in order to increase overall employee compensation, or the meals are provided when employees are not working.
As long as you can make the connection between the person receiving the thank you gift and a legitimate business purpose, you may deduct business gifts up to $25 per recipient. For more information, see IRS publication 463, travel, gift, and car expenses.
Entertainment expenses are not deductible, but promotional events for customers are deductible, and recreational team building or appreciation events for employees are deductible. Promotional events such as harvest festivals are events to bring customers to your farm. They may have an entertainment element such as children's games and rides and music and dancing. Recreational events for employees would be an expense for a summer outing to the local water park. These are events that are designed to help you maintain or improve employee morale, performance, and retention.
If you go to see a music or a movie with someone who markets your products, you cannot deduct the cost of the ticket. You may deduct the cost of parking at a hotel and renting a hotel conference room for a business meeting, or you may deduct admission and parking costs if you go to a local park and have a walking meeting with someone rather than having a business meeting in a hotel conference room. The important point is that the primary purpose and activity is the business meeting. You will need some written notes about what you talked about that make a clear connection between the meeting and your business.
When you have business supplies on hand at the end of the year, the general rule for all taxpayers is actually an advanced topic covered in training number 6. We'll talk right now about the special rule for farmers.
Generally, you may deduct an expense in the year it was paid, but there are special rules for prepaid expenses since they are paid in one year but used in another. Special rule for prepaid farm expenses like feed, seed, fertilizer, or other similar farm supplies. Your deduction is capped at 50% of your total other farm expense deductions unless one of the following is true. Number one, the prepaid farm supplies expense is more than 50% of the other deductible farm expenses because of a change in business operations caused by unusual circumstances. Number two, the total prepaid farm supplies expense for the preceding 3 tax years is less than 50% of the total other deductible farm expenses for those 3 tax years. Also, one of the following must apply. A, taxpayer's principal residence is on a farm. B, taxpayer's principal occupation is farming. Or C, taxpayer is a member of the family of a taxpayer who meets the requirement of A or B.
For more information, see IRS Publication 225 and 535. Go back one.
Okay.
So there's additional special requirements when you have value added inventory. If at the end of the year you have value added inventory intended for sale, you may not be able to deduct all of the costs you incurred in order to have that inventory. Instead, you may need to hold some of those costs as an inventory asset. When something's an asset, that means you can't deduct it. If you hold it as an inventory asset, you can only take the full deduction in the year you sell the inventory items. The rules for this were greatly simplified in 2017 for all taxpayers with income less than $25 million, but they're still a bit tricky to understand. Crops and livestock are not inventory held for sale. Value-added products such as cheese and wine are considered inventory held for sale.
Proper tax treatment of these items is beyond the scope of this presentation, but is covered in additional detail in Lesson 6. For more information, you can see IRS Publications 225 and 535.
For general matters, the IRS must audit within 3 years. But if there has been a substantial, and that means 25% or more, substantial understatement of income, the IRS has 6 years to audit.
But if you do not file a tax return or have filed but willfully fail to report income, the IRS can go back as far as they want.
There are numerous resources on the IRS website for how to reconstruct records lost due to natural disaster. See the webpage Reconstructing Records After a Natural Disaster or Casualty Loss.
There is no specific requirement to use a particular method to keep your records and summarize your individual transactions into the groupings required on the IRS forms.
For very small operations, simply keeping receipts would be the least amount of record keeping required to complete a tax return. But using this method is slow and it will not be clear and accurate if there are lots of transactions. If you do not have a receipt for something, you will not include it and your returns will be inaccurate.
If you give your receipts to a tax preparer to total, and they may make many mistakes and they will charge you extra. If you have losses in 3 years out of 5, it will be difficult for you to demonstrate that you have a genuine profit motive if this is the only financial record keeping method you use. Remember the discussion of hobby loss rules from Lesson 1.
The next method people use is some sort of a paper spreadsheet or program to create a register. This method is slow and it will not be clear and accurate if there are lots of transactions. There's no built-in way for you to verify that you have correctly recorded each transaction, even if you use your bank statement or credit card statement to guide you.
And again, if you give this register to a tax preparer to total, they may make mistakes and they will charge you extra. If you have losses in 3 out of 5 years, it will be difficult for you to demonstrate that you have a genuine profit motive if this is the only financial record keeping method you use.
There are some simplified manual or computer-assisted bookkeeping systems that can be helpful. These methods may be sufficient for many small businesses, and it was certainly the norm prior to the 1990s. The DOME system has many built-in processes to help ensure you are accurate in how you record and group your transactions.
This method is still slower and less accurate than proper double entry bookkeeping, but it can be a good way to get started and a good way to learn some of the basics of bookkeeping. If you use the system carefully as instructed and create all of the final year-end summary reports, you should be able to use those reports to prepare your tax returns, and a paid tax preparer will not charge you extra.
Depending on the size and complexity of your operation, using this system would probably not count against you if the IRS asked you to demonstrate that you operate your business with a genuine profit motive.
You can use a double entry bookkeeping system to record all of your transactions. This is a computerized system, takes care of the math and the balancing for you. You record the date and amount of the transaction, and if the transaction is for cash or credit, and the program will ask you to choose a category for the transaction, such as sales or type of expenses. Everything is grouped for you according to the categories you select. If you set the categories up incorrectly or you do not know how to choose the right category for an item, you will have incorrect records. So you do need to do some work to get a system set up correctly and to make sure you are using it correctly.
You can also work with a professional bookkeeper who will direct you on what information they need and how to get that information to them, and they will do the rest. If you use a bookkeeper, you can save yourself a lot of time, but you must review their work and understand the reports they give you each month, or you may miss significant errors.
Anything less than a double entry bookkeeping system is less than a best practice and not recommended as a long-term strategy for a business that has a genuine profit motive, unless you are extremely small and have no desire to become bigger, have more monthly transactions than you can easily handle with a manual system.
An additional caution: there are several programs and apps that will record some of your business activity for free or at a very low cost, but then they require you to pay additional fees to access the full functionality of double entry bookkeeping. For an example, there are apps that allow you to create invoices and receive and make payments. They may help you a lot in your day-to-day business, but they will not allow you to create a balance sheet that shows all of your assets and liabilities and your contributions to and withdrawals from your business.
A balance sheet shows where your business is at a moment in time, usually the end of a month, quarter, or year. An income statement shows total sales and expenses for the year to date and closes out at the end of each year. Net income, which is sales greater than expenses, increases the value of owner's equity on the balance sheet. Net losses, where expenses are greater than sales, decrease the value of the owner's equity on the balance sheet.
The only way to have a balance sheet is to have double entry bookkeeping. And the balance sheet is the essential management tool you need to manage your assets and liabilities. Without a balance sheet, it is hard to see how you are building equity in your business by acquiring valuable assets and paying down debt. The balance sheet is also important for risk management because it helps you to think about buying insurance to protect your assets or to ensure that you will continue to be able to pay your debts after a disaster.
A reconciliation is a mathematical proof that every transaction recorded by the financial institution is recorded in the accounting system, and every transaction recorded in the accounting system is either also recorded by the financial institution or can be explained as a cash transaction, uncashed check, etc.
If you hire a bookkeeper, the most important thing you can do is review the bank and credit card reconciliations each month to see that they are being done and that there are no items showing as unreconciled or uncleared that cannot be explained.
Another important part of bookkeeping is maintaining all of the source documents that were used to generate the entries into the bookkeeping system. These are all of the primary source documents that IRS requires you to keep: bank statements, credit card statements, sales and purchase receipts, mileage records, and other notations regarding the business purpose of the transaction.
You may not be the best person to be the bookkeeper for your business. A bookkeeper may be able to add a lot of value to your business by doing the bookkeeping for you and freeing up some of your time for other management activities, like looking at the balance sheet and income statement and using them to make decisions. If you hire a bookkeeper, it is still important for you to know how to oversee their work and for you to be able to function for short periods of time without them.
The options for preparing your federal income tax return include filling in the IRS forms using a pen or a pencil or a fillable PDF, or having your tax return prepared at a volunteer income tax assistance clinic. These options only work for very simple returns with no business income. If you're self-employed and have business deductions related to vehicles and other assets, or if you have real estate used in your business and for your residence, you will not be able to complete the forms without the assistance of a tax preparation software or a tax professional who is for sure using tax preparation software. Most volunteer income tax assistance clinics do not serve people with self-employment income, although there are some exceptions. You can use tax preparation software like TurboTax or H&R Block. If you choose this option, you should prepare carefully. Before you begin, you should take classes like this and read resources like the publication 225 so you will understand the questions that the software will ask. Before you begin to use the tax preparation software, you will need to have summaries of all of your business transactions using the standard categories required by the tax return. The best source of this information is from a double entry bookkeeping system. Other sources are more likely to be incomplete and inaccurate.
You should have an idea of some of the important things you expect to see on your tax return. For example, a Schedule F reporting farm or ranch activity and a schedule showing farm assets and depreciation. That way, if you finish answering the questions and you review your return and you do not see things you expect to see, you at least know the draft is wrong and you need to go back and figure out how to get results that are closer to your expectations.
You can use an enrolled agent, including a tax preparation service like H&R Block or Jackson Hewitt. The results will vary greatly. Some EAs are really good. Others only meet the most basic competency requirements. The EA license is given by the IRS to people who pass a basic test.
Some EAs may be expert in small business or agricultural businesses, but most do not want to work with any business that is not a very simple Schedule C. Many farmers and ranchers report that EAs incorrectly tell them to use Schedule C rather than Schedule F, and many report that EAs incorrectly tell them that because their farm or ranch loses money, they are a hobby and cannot file as a business.
An EA with expansive agricultural or small business experience can be more competent than a CPA who does not have many years of small business experience or who does not have any experience with farm or ranch returns. Another option is the use of a certified public accountant, and this could be your best option if your records are in good order. Many CPAs also provide excellent bookkeeping services, but you will pay top dollar to have your financials put into standard order, meaning double entry bookkeeping by a CPA's bookkeeper. It may be difficult to find a CPA who is a good fit for your business. Some CPAs have friendly, casual offices and are happy to work with small businesses, but other offices are quite formal and not very small business friendly. CPAs are in short supply, and most have more business than they can handle. But if you're going to take the time to hire a CPA and pay the higher fees they charge, be sure to find someone who is willing to take the time to ask you questions, understand your full business and personal situation, and give you actual advice. If you do not have these detailed conversations with your CPA, you're not getting the real value out of paying the higher fee.
Results from using a CPA also vary greatly, but because it is very difficult to obtain and maintain a CPA license, you are more likely to get a good result from working with a CPA. CPAs are regulated by their state board of accountancy. They are required to have at least a 4-year degree and pass a rigorous 3-day examination. Many very expert CPAs get a lot wrong when it comes to farm or ranch taxes, though, and some will discourage you from becoming their client because your tax situation is relatively complex and they know that you probably can't pay the higher fees that they charge other clients. When looking for a CPA, don't be shy about asking if they have farm or ranch experience and asking them to consult Pub 225 and ruraltax.org if they have questions. For additional information, there are other courses in this series, and you can access at the links provided in the materials.
You can also look at IRS publication 225, the Farmer's Tax Guide. You can go to ruraltax.org or the IRS website and its publications.
Thank you.